You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
Good afternoon and welcome to the Thursday edition of the Option Block. My name is Mike Tussaw, broadcasting live from 50 miles outside the home of both the Bulls and the Bears. And folks, I am not talking about the sports teams. I am talking about the traders, Chicago, Illinois, the mecca of all option trading, broadcasting live from St. Charles, Illinois, the lovely, scenic hamlet, as Mark Longo likes to refer to it as. Mark is vacationing at this point in time on a much well-deserved rest period with his family. Hopefully they are enjoying themselves. So today I am trying to fill the ginormous shoes with which Mark has in the host chair, in the hot seat, as Mark likes to call it. And with me today, we have from the Commonwealth of Maine, the state, I don't know if it's a state in the union or a state of mind. It could be a lot of things. The great area of Maine, it's a very beautiful place from every time I've been there anyway. We have my co-host, Mr. Andrew Giovinazzi. Andrew, how are you today?
I think Longo calls it the Duchy.
The Duchy, that's right.
As in past the Duchy on the left. Do you remember that song about 5,000 years ago?
I do.
So things are good in Maine. I have a little bit of a chest cold, but I'm gonna try to persevere. This morning was kind of ugly, but now is better. So I am here.
Well, you live in Maine, so you live in Maine. So how bad can it be?
Yeah, you have a point there. It's not so bad here, I have to say.
That's a good thing. Well, with that, let's proceed directly into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
And I'm looking on my screen today, Andrew, and I am not seeing a lot of movement in a lot of things. The main thing that I am seeing some movement in is the biotechs, which we can talk about. But before we get into some of the various sectors and things of that nature, I know energy will probably be a story, something we can talk about a little bit as well, even though it didn't really do much today. But what's going on in the land of the sticks or the icks or VIX? That's what it's called. Yes.
Well, the land of the VIX, we had a little markup today for a while, I think close to 11, and VIX peeled off to the day, actually getting down to around 1020. So as far as VIX land goes, it's just kind of everything is very normal. Excuse me. You've got low volatility, low realized volatility. The future premium is probably a touch light. Not terrible. Almost all volatility. I was just doing a seminar, internal option pit webinar, and they were taking the weekend out pretty handily today as far as option prices go. So taking the weekend out means the liquidity providers were already starting to forward roll the pricing down. So, options are decaying a little faster than normal today. And you had a little bit of a swing in the market. I think we were up about 0.5% or 30, or let's say 30 basis points, I guess. at one point, and then everything just sort of peeled back. They started selling retail a little bit toward the end of the day, but other than that, I mean, it is a market looking for the next thing. And you did mention biotech. I think they liked biotech when it looks like they were going to pass this healthcare bill, and now all of a sudden it feels like they cooled to it a little bit. So, because I saw some of the biotechs were up a lot more today than where they closed. So, but they're still trading at, I believe, 12-month highs as we speak right now.
Yeah, I'm looking at IBB, the biotech ETF, just to kind of give the listeners an idea of it. The low of the year is 240. I'm sorry, the 12-month low is roughly 240. And it's kind of been channeling since probably about late February between like the 290, 300 level. Sometimes it would dip a little bit below it. Sometimes it would go a little bit above it. But for the most part, it's been really in quite the channeling phase, but then all of a sudden in the last couple days, or this week I should say, it's up roughly $25. Today it got as high as $323.45, closing at 320.11. So it's didn't quite close on its highs, but it is up a little over 1% again today, and definitely something interesting to watch, because if we do if legislation is what's driving this, then there's a lot more to come with this, in my humble opinion. I think we'll get a little bit of a pullback, but I could see a lot higher pricing for this. But this is one to where if it looks like something changes with the passing of the healthcare bill, or and just in general, whatever drives anything, if we have some type of a change in this is something to where this could be easy come, easy go type of thing. But the thing that I like about this, if you're a biotech bull, is that you have a lot of stability in the stock up before the 300 level. So on here, even if you were to, like, say, want to ride the momentum higher a little bit, so to speak, there really is some type of stability, relatively speaking, of course, with IBB. I mean, it does kind of go all over the place, but if you are an IBB bull, this might not be a bad breakout to try and buy. That is, of course, if you are a breakout type of person. Now, the other thing to consider on here, IBB was as high as 400, about 2 years ago. So it has touched the 400 mark, and so by breakout, I mean it's a breakout over the course of the last year and a half to 2 years. Year and a half or so. But we were as high as 400 in the same underlying about 2 years ago. So that's something to be considered of, and that's the all-time highs on the biotech ETF. Don't get complacent if you're doing this, because I can remember watching this over the course of the last couple months and seeing this is one of the few things that actually would react to political news throughout the day. A lot of things, I know we had talked about this on the show last week, all the times that Trump's going to be up for treason. No, the FBI director is saying this about him. Oh, this, that, and the other. Now, whether it's true or not, who knows? But we had talked about on the show how if this had happened to a past president, whether it's Clinton, Obama, Bush, or Bush Sr., or whatever the case may be, this would have moved the market. But right now, it's like the market doesn't even care. One of the few things from the political spectrum that the market does seem to care about, from my standpoint, or from what I'm watching throughout the day, is this biotech ETF. And this is one of the few ones that you can get, it seems, a little bit of movement on some type of political news. This is like, it's almost like if Trump's speaking on biotechs, it's almost like watching the Fed back in the old days. Because watching the Fed these days, it seems like it's been a resounding meh, as Longo would put it. The other thing that I was looking at throughout the day, not a lot of movement today, but energy. Just kind of like thinking of like the CNC Music Factory. Energy, energy, bang. Think of that song, that old song, Here We Go. And with that, the other thing on there, it's kind of one of those things that make you go, because everybody hates energy right now. Energy is just so horrible. I think I was reading somewhere how like the short crude futures is a very crowded trade at this point in time. And so I really believe, I've been an energy bull for a long, long time. It's gone up, it's come down. I'm still holding on to my XLE position, very happy to do so. But here's the benefit of it. Two benefits. Number one, a lot of energy stocks, XLE included, the ETF that tracks the energy stocks, they pay a dividend. And on top of that, as if life couldn't get any better, they pay a dividend at the pump today. I just paid, I know this is probably not that big a deal for a Mainer, that you guys probably pay like 30 cents a gallon for gas, but I filled up today for $2.14 a gallon. And with that, the lower energy prices that's very beneficial in the suburban Chicagoland. So I believe that energy kind of pays a double dividend in that not only do you have the dividend in the underlying, but you have kind of a dividend by not paying as much at the pump when it goes down. We're all natural energy bearers because of the fact that we all buy gas or natural gas in the winter for heating our homes, or heating oil if you're out east in places, whatever the case may be. But what I really like about the energy trade right now is that, number one, it's lower. Number two, everybody hates energy, it seems. And number three, even if it doesn't go up, you still benefit by not paying as much at the pump. Now, of course, if you're putting in millions of dollars into the energy trade, like Andrew and Mark do in their account probably, the gasoline benefit probably doesn't help you that much. But if you're a retail trader and you have $7 or $8 grand in XLE, something like that, that's something that I think can be pretty significant on it. So that was kind of my take today on what's going on. Any thoughts on energy or biotechs at all, Andrew?
I like both of those ideas. An idea that got beaten around a little bit was AMJ or the MLP, those master limited partnership, all the pipeline companies. So even with gas being distributed and oil being distributed, it's going through pipelines, shale pipelines. It was one of the guys in our chat room. And the thing is they're getting sold off with oil in general, but that stuff is still going to flow through the pipelines. And they're paying still pretty good dividends. So that, AMJ is a 7% dividend at this point. So some of those don't look too bad. You might have a little bit of a ride in between, but they still, as far as a value play, I don't think those pipeline companies are going away in the next 20 years. So that is definitely a thought. The biotech, definitely a thought. Also, vol moving a lot higher with the biotechs going up too. So IBB is up, what, $24 in 4 days. So it feels like it's a bit of a short, a little bit of a squeeze as well. So all of that stuff is just contributing to, I think the market is trying to find new places to go with the SPX at 24.34. So it's looking.
It is looking for sure. Well, hopefully we'll find a home. It'll find a home for itself. So anyway, well, let's conclude the trading block for today, and let's move into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
And welcome to the Odd Block, everybody. This is where we like to look at trades that are a little bit odd, unusual activity, see what's going on with things, and try and parse and figure out what's happening, and try and determine if the big money is necessarily the smart money, which oftentimes it may or may not be. And Andrew, do you have anything odd in your world today?
Well, I think we're going to stick on that concept of master limited partnerships. On a kind of a sort of a slow day, Plains All American Pipelines, which is PAA, that's trading $23.90. Now, it was up today. It's trading very close to its 52-week low of $23.21. So that is, it's reflecting oil prices going down. However, it just transports the stuff. But the big trade was 20,000 of the August 1824 puts traded 137. that actually looked closing, that part. There was a massive open interest on the 24 line, so it looked like that was closing. I have to see tomorrow to see to make sure, but it's kind of, it looks like it closed. It looks like they sold the puts to close, so they were long them, and now they're trying to, like I said, the way the pricing looks, they changed direction and actually sold 20,000 of the 21-23 puts. Again, that's the way the pricing sort of stacked up. So the way it looks like, the other possibility, because this could be fresh open interest, so they bought the 21 puts and then they sold 23 and 24 puts. So it would be kind of a reverse Christmas tree almost. But the trade did look. It looks like either way they're trying to get out of the more in the money puts and get into the more out of the money puts. So it has a little bit of a bullish tint, sort of. Kind of a line in the sand for PAA down here at just under $24. So that was one semi-interesting trade, kind of going along with the oil.
I don't know, a anything that says reverse Christmas tree in it sounds more than semi-interesting to me.
Well, you don't see a lot of reverse Christmas trees around. That would be like going to the Christmas tree farm and all the trees are upside down on their head. So that would be a little strange, don't you think?
That sounds like a crazy Sesame Street tall tale type of thing to me.
It does. Next is Praxair, symbol PX. Well, what do we have here? We have crazy opening call spread buyers, 15,000 times. Praxair is, I think it's trading close to its highs at close 132.47. The high of the year is 137.89, so we're pretty much trading right there. This is a stock that is an industrial gas company. So, kind of all the operational gases, argon, nitrogen, all that kind of stuff. Hydrogen, just making gas. Big industrial supplier. What we have is somebody bought the August 140, 155 call spread, and they paid $1.53. So kind of a cheap upside call spread, but really expecting something pretty fantastic to happen. It would not surprise me if this would be a takeover candidate, to be honest. It would not surprise me at all. This is sort of, it's a big industrial company. It has good cash flow, and it's the kind of thing that I could imagine somebody sort of prowling after. But, it pays a pretty good dividend. It pays a $3 a year dividend, so that's not a small yield. So anyway, that's what that one looks like to me. But that's a pretty aggressive purchase to buy an out of the money call spread in sort of a good but sort of slow and kind of clunky stock. So those are kind of a couple of standout trades on a very, what I would say, flat ho-hum day.
I would agree with that for sure. So anyway, well, that concludes the odd block for today.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
Today, what we want to do for the strategy block, it is Thursday, but it's just Andrew and me today. So I was thinking of some ways with which we can make this a little bit more. I wanted to maybe hear some old stories from Andrew from his floor trading days, and then with this one issue that I have that some of our listeners may have, some of them may not, but I want to go through a situation that it happens to me rather frequently. But it may or may not happen to some of our traders, but I just kind of want to go through it to where we have an understanding as to what to do. Now, if you're a beginner, hopefully you're just trading 1 to 5 lots in your contracts. If you're trading like 50 lots of something really small and it's really not a lot of risk, then I still think maybe you should modify your strategy a little bit. But hopefully you're trading 1 to 10 contracts and you're not risking a ton of money. I don't care how wealthy you are. But as you get into this a little bit more and as you start trading more size, it kind of becomes a different, not kind of, it does become a different ball game with what you do. So I'm going to paint a situation or a scenario for the listeners and for Andrew and I to talk about, and we're going to kind of go through some ways with which we can work with this and kind of make this happen. Now, let's say that we are short a put spread, and let's start off with a winning scenario. We sold this put spread, and we'll make the put spread on SPY, the most liquid ETF that there is. So if you want liquidity, it's going to be difficult to find more liquidity than SPY. And we sold the put spread for 50 cents, let's say, vertical put spread, and market's gone up, time decays happened, vols gone down, whatever the case may be. And now it's time to get out of this put spread for 10 cents. This was our goal. We wanted to hit at least 80% of the potential credit on it. We don't want to let it go into expiration because that's that can be a bad thing. And we want to get out of it. So we see on the quote screen that the spread, not the individual options, but the spread itself is trading at 8 cents by 10 cents. So in theory, what we need to do is we need to get out of this at 10 cents. So we put in the order to buy to close at 10 cents, and we're not getting filled. And we're thinking, well, wait a second, why are we not getting filled right away? The offer's at 10 cents. We're willing to get out of this at the offer. This should be a no-brainer. This should be filled within a millisecond. Why is this taking so much time? Still no fill. Well, then we realize that the quote that we receive is from 2 different exchanges. One exchange is trading the options at one price, one is at another. So we're just seeing the kind of the best of both worlds in terms of what the fill price could actually be. So with that being said, what can we do in such a situation? Well, there's a couple things we can do. One, we can just be patient and wait and think, okay, well, at some point, maybe they'll, maybe the quotes will match up and maybe we can get out of this. Let's just be patient. Maybe the market will go up a little bit more and help us out a little bit on this trade, on this fill. Or another scenario is we could say, all right, cancel the spread order and then buy to close the short put, and then immediately right after that, sell to close the long put, and you buy to close the short put for maybe 12 cents, sell to close the long put for 2 cents, let's say, and then it's the same thing either way. You can go that route perhaps. Or another way with which you can do it is maybe just say, you know what, I'm going to get out of this at 11 cents. I'll pay the extra penny. I just need to get out of this because 1 penny's not going to make my week, whereas I'm happy being 1 penny short of my profit target. So there's 3 basic scenarios with which you can do this, and oftentimes this happens when you have more size. I shouldn't say oftentimes with more size. I mean, this could happen on a 1 lot, but if you have a lot of size in your account and you're trading, say, a 500 lot, then here's one of the risks with which you also take, and that's a partial fill. Now, we'll get to that in a second, but before we get to the partial fill risk, Andrew, do you have any thoughts on that when the price of the spread you should be able to get out of, but the fact that the options are priced differently at different exchanges, you're not able to get out of it right away? What are some things that maybe you've run into back in your day, and or even still in your day right now, obviously, but what are some things with which you would do in a situation like that, and how would you counsel our listeners?
So the first thing I think when you're closing a trade is you should focus on closing the trade. Don't get too cute, right? Because this is just like you said, where you get a partial order, you're like, oh, I think I filled, I did it. And then you go back and you didn't do it, and then the market turns around or something like that. Then you get bitter and sad. So I think 1 is you're going to close a trade, close a trade. 2, using a limit order is a good idea. You never know what kind of electronic order might be working as well, kind of screwing up what you're trying to do. It is possible, you look at an electronic order book and see if there's what's going on, but it is possible there could be a competing bid or something that's making it more difficult for you to fill. One thing I do, though, if I'm going to trade something like that, I'm going to close the short side first. So, if you have it on both exchanges, depending on how your firm is going to ding you for a ticket charge or something like that.
Which, by the way, we have none at RCM if you're under our umbrella. Anyway, go on.
That's a good shameless plug, but a good spot for it. So, bidding a penny through generally should get you what you want these days, and bidding a penny through might actually get you your original price, as strange as that may seem, just because of the way it sets up, because almost all of the order flow now is filled with an algorithm to some degree, where the liquidity providers have kind of think of it. Do you remember Battlestar Galactica? Where you have that. What were those called? The Cylons. Where they had that eye that wing. So you think about you're putting your order into the world of the Cylons, and then as it passes its roving red eye, it gets filled. It's not like the old days where it was kind of a clunky electronic order system. It worked fine, but there wasn't any algorithmic smarts until later, about I would say 2000, 2001. Some really smart firms a little before that, where they were able to actually do things inside the markets. So those are the type of things that can make it more difficult for you to fill. So I think the idea of just making sure you get what you want done, use a penny, close the short side first. Those are the things you should focus on, because once you decide to close something, just close it. Don't think too much about it, because you don't want to give yourself too many opportunities to second guess.
I would agree on that, and that's true. I've had that happen before. If let's say the bid ask on the spread itself is 8 cents by 10 cents, and I put out an order to buy to close at 11 cents, oftentimes, like let's say I'm doing like a 500 lot or something like that, oftentimes probably 450 of the 500 contracts actually do get filled at 10 cents. There were just a couple at the 11 cents. And so because of the fact that we have separately managed accounts, everything gets split and everyone gets the technical fill at 10 cents and 0.2 of a penny or whatever that averages out to. So I've had that happen to me very frequently. So I agree with you in that if you want to get out of a trade, get out of a trade and don't try and get too cute. Because if all of a sudden, let's say that you try to actually just wait for it, and you're seeing right there that you can get out of it and then maybe just not quite get the penny that you want. And if pennies really mean something to you in option trades, then, well, they're nice and they're important, but quite frankly, I think you're listening to the wrong show, because I don't think there's anybody in here and on this show that would say, all right, I'm having trouble getting out at 10 cents. Let's just get out at 11 cents, just so we can get out. And maybe it was a bad quote. Well, if that's the case, then we can call up the broker and ask about the bad quote later and see what's happening. But let's not gamble on this for 1 penny. We've worked very hard for this 59-cent profit or 80-cent profit or whatever it is. Let's not worry about 1 penny. Let's get out. And I total agreement on that with you, Andrew. Now, here's the next one. Now, this is an interesting question. This is just kind of another scenario. Let's say that you're trading. Let's say you're trading, maybe you've taken the option pick classes, you've taken the master class, let's say. So let's say you're doing 50 lots on the SPY or even SPX, or a 50 lot on something. And you want to, let's go same scenario, you're doing, let's say, a vertical put spread. You can do this with a calendar, a call spread, whatever you wanted, but let's just say it's on a put spread. And same scenario, but this time you're doing a 50 lot and you get filled at 10 cents, but you only get filled on 30 of the 50 contracts. And you're looking at it, you prematurely got filled. You weren't expecting to get filled right away. The market moved your way a little bit sooner than you thought. Maybe there was, you weren't expecting the vol to drop as quickly as it did. Whatever the case may be, you were maybe expecting to get filled either later in the day or another day or two from now, but you're filled on 30 of the 50 contracts. Do you A, just sit there and watch it, or B, do you go out and say, you know what, I want to get out of this right now because I've already gotten filled on 30 of the 50. I'm just going to raise my price to maybe from a dime to say maybe 14 cents or something like that, because I got filled when I went to the bathroom. So that's why rule number one, of course, you never go to the bathroom while you're trading. You hire me because I never go to the bathroom, quite honestly, during the day. Just kidding, of course. But with that, you got filled when you went to the bathroom, and it's 4 cents off where you got filled at. Do you just say, you know what, I'm just going to pay the extra 4 cents and get out now and just be happy that I got it? Or do you wait and be stubborn and go for that? I mean, what are some of your thoughts on partial fills, Andrew?
So you're partial fill to open or partial fill to close? That's the question.
We'll say to close in this case.
Okay. So I can tell you error stories where I should have gotten out, but I didn't. So so I guess to make a long story short, we had an electronic execution system for the firm I was working at the time, Group 1, and I had a lot of gamma. I had about 50,000 gamma for a position. So I had scaled orders up and down the market. And the scaled order, my stock clerk put the scaled order in wrong. So the stock actually opened down like quite a bit. And I went, oh my gosh. So I probably just bought like, 25 or 30,000 shares. And what I heard, and then, 5 minutes later, I didn't get a response, or 10 minutes later, 15 minutes later. So everybody in my pit was getting fills because we all just had a ton of gamma and we're sort of choking on it. And so what happened is I learned later that since my stock clerk put the order in wrong, I filled the whole crowd at the bottom, so to speak, by selling stock. And I looked at it and I go, well, I got a lot of gamma. It'll all work out in the end. So literally the next day, the stock got taken over. So that error cost me, I don't know, probably $300,000 in missed opportunity. I still had some gamma left, but it wasn't near as good as it would have been had I just kind of covered my stock error for 25 cents. The problem was the stock had gapped down, filled, and then sort of drifted back up. So it would have been a slightly expensive error, but it could have easily been taken care of with 1 or 2 days of trading, but I didn't do it. I got stubborn. So what I would say is, excuse me, being stubborn can be expensive. So if you want to close and you miss something and you still want to close and the market gets away from you, I mean, to me, you close the trade. It's 4 cents, just do it. Because, if you won't do it at 4, you're not going to do it at 6. You're not going to do it at 8, and you're not going to do it at 10.
But then you will at 40.
Then you will at 40, right? So, and that was, and after that, I just made a habit of just, excuse me, fixing whatever errors or mistakes I had right away. So that you can use my little war story to possibly save yourself a bunch of heartache. Nobody ever regrets a closed position for money. When you think about it, I closed that position, I could have made more, but it wears off after about 5 minutes, and you say, I closed the position, I made money. So you have a lot of regret when there's a position you could have easily closed and you held out for a penny, right? Then you're kicking yourself in the teeth for the next 3 days. So I think it's just, and it's also a personality thing. What can you stand personally? I much rather would just like to close something and pay up if I need to and be done than having to be angry at myself for missing the opportunity. So that's my own little psychological, my little tell just trying to close trades.
I think that makes a lot of sense. And, almost every trader I've ever talked to, and myself personally, I don't know of anyone who, like, if you were to say the top 10 most important characteristics of being a trader, I don't think that there'd be anyone that would say that, well, number one on my list is to be disciplined about closing at exactly the price I wanted to close at and not giving up a few pennies. I mean, Andrew, do you know of any trader that would have that as like a firm rule within their trading rule book?
Oh, just saying no matter what, within a few pennies I closed? Yes.
Yeah, so But I mean, like if someone says that if I don't get the exact price I want, I'm staying in, I'm willing to bet there's very few that think that way.
Oh, yeah. No, not many. Not many that are still trading.
Right. So like, here's something that I related to. Like I coach high school football as well, and recently, just during individual practice is all different now. Two-a-days really don't exist anymore like they used to, but there's more frequent practices in the summer now. So two of my linemen were getting into a fight, and so I stopped it. And so what's happening is that after the whistle blows, when guys shove each other, that doesn't hurt. It doesn't hurt at all. No one's ever hurt anybody that way. I mean, just shoving in the shoulder pads, it's stupid. But what I always tell them is that real men take care of business between the whistles. If you want to hurt someone in football, you have the ability to sprint at them as fast as you possibly can, legally punch them with your hands, and then put them on their back and make them hurt in real pain. That's when real men deal with stuff. If you're just shoving someone after the whistle, that's not going to hurt them. But if you're really mad at someone and you really think that you're tougher than that guy and you want to show him something, take care of business between the whistles. So I would say in the same realm, real traders make money by being disciplined and cautious. They don't make money by trying to be greedy over a couple of pennies. So I really think that with this scenario, it's important to be cautious in this situation. So anyway, that is the combined war story / strategy block for today. And it is Thursday. We did the strategy block, but we do have some time for some listener questions. So let's go into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
And welcome to the Mail Block, everybody. This is when we get to hear about what you guys have to say. What are your thoughts on some things? And we got time for a couple questions today. The first one would be from Frank C. And Frank has a question that I really don't have a ton of experience with, but I do have some thoughts on. I'm sure you do as well, Andrew. Can you do a review of second-order Greeks and when to use them?
You know what's funny about this is I've always struggled to remember the dang names of these. So I figure second-order Greeks, they're talking about Voma and Vanna and all of the second derivatives after gamma and delta and vega and stuff like that. So the first thing I would say is the second-order Greeks are telling you how your position is going to curve a little bit when volatility changes a lot. So where do you really need to worry about them, right? So I think a second-order Greek is when do they really matter to you? Mostly when you're dealing with out-of-money options, because that's where the changes in vega, changes in gamma are kind of the biggest. Stuff at the money, the vega doesn't change. I mean, volatility can go up and down, but the vega per contract doesn't change. It's your vega, your Greeks per contract change pretty significantly, and there's more curve with all the little options out of the money once volatility starts to move around. So it really depends on what you trade and what you're interested in, and also too if you trade fairly large spreads or butterflies, because the second order Greeks really matter when you're spreading one option against another. You're trying to capture some edge in a fly between strikes, because you want to see how one option is going to curve against another option. So when you trade a fly, and you sometimes, and I had clients or just some option people come in like, I sold this fly, I don't make any money. I don't understand. Why aren't I getting any decay? And that's because, one option might be decaying, but another option is moving against, a long option is moving against a short option in a way that the client didn't expect, right? And that's a second order Greek, basically, how, how those out of the money options are going to move relative to a more in the money option. So I think that's probably where it matters the most. But for most trades, if you just buy a call spread or a put spread, you just want the market to move, it's not really going to matter because mostly the delta is going to overwhelm just about anything with that particular trade. I think it matters mostly. It's not that it doesn't matter in the equities, but as far as the dollars involved, it matters a lot more in the indexes just because there's a lot of Vega per contract in the indexes. So if you don't really trade indexes or index options, it's not a big concern. But and one of these days I'll learn what all the second order Greeks are. But I do know how the options move just because I've just watched them and traded them forever. But I will learn what those names are one of these days. I've decided.
One of these days.
One of these days. 25 years later.
Of course. Yeah, because when I typically just look at the option, and I understand what Vega is doing to it. I understand what Delta is doing to it, or what's doing what to it, just based on what I'm seeing. Personally, I don't look at like what's the position Vega, what's the position Gamma, or anything like that. I do look at what the position Delta is initially, but it's really not a huge factor in any of my decision making, just because I'm just looking and watching what the option itself is doing. But with that, I never had the need to say, I wonder what and I don't even know what the heck those letters are either. I wonder what that is doing. Why is this doing it? So at least at what I'm doing with my clients, it's a non-issue for me personally, but like you said, there are times to where it can be based on what's going on. So brings us to our next question, which has absolutely nothing to do with second order Greeks, but I still think it's a good question. It's from ZX45. Last show, this is based upon our conversation last show about becoming a market maker, and we had talked about how it can be difficult to become one. Maybe you go the financial advisor route, and we had talked about doing that. But this question is it now actually a good time to become a market maker? I read in Barron's that there aren't many of them left, so there's not much competition. And how did Mike get in if he wasn't a trader? So, Andrew, I'll let you take the first couple questions on that one, and then I'll go ahead and tell my story for the last one.
Well, there's still a lot of competition, except the competition's now Citadel and Goldman Sachs, excuse me, and a lot of other deep-pocketed hedge funds. That stream quotes, which never used to do that, I would say is, probably 15 years ago. But now most of the liquidity providers, it's very competitive, and it's very expensive because they are spending tons of money in kind of an arms race to get quotes into the marketplace fastest to be, to get in front of the order flow. So it is very competitive. There just is not a lot of what we'll call sole proprietors anymore because, the exchanges, for whatever reason, a lot of the rules and everything kind of went to favor, kind of the scale type trading. Because there was time priority. So if your quote switched faster than everybody else's and an order came in, you'd be first. Just like in the old days, if you were first, you get to decide how much of a trade you want on a trading floor. So that it's still there. Now, are there places where you can trade? Yep. You need a lot more infrastructure and help than you did before. You need to be pretty good at systems. Not only do you have to know how to trade options, but you have to be fairly adept at the systems. And like I said, there's a lot of the trading is run by algorithms inside the quoting structure. So you need a firm that will help you do that. And they're out there for sure. But it is not an easy business as it used to be. It's also a lot more capital intensive than it used to be. There's a lot of stuff. You're just not showing up anymore onto a trading floor and kind of going for it like it used to be in the old days. It's a tougher racket. It's a more automated racket than it was before. So you can catch the second part of that question.
Okay, that's a good question. Well, how the heck did I get mixed up in this whole thing if I wasn't ever a floor trader? Well, my story is that I when I got cut from the Buffalo Bills. I played in the NFL briefly. And basically, for a year of my life, I was spent waiting for a phone call. And I spent that year as a substitute teacher at a local high school. And at the time, I was probably 320 pounds. And for anyone that's ever been a substitute teacher before, you either have to be a jerk to the kids or you're going to get walked on. That's just a simple fact of life. So being 320 pounds, it was kind of easy to be a jerk to the kids, quite honestly. Now, I did coach football at the same school, so at least my football players knew that I wasn't a total jerk, at least anyway, and they knew, and I even told them, I'm like, look, I'm going to be a total jerk because I know how you guys treat subs, and they were understanding at least, but everyone else probably thought I was a jerk. But anyway, what I would do at the beginning of every class period was I would stand up, and I'd basically talk like a drill sergeant saying, you will be quiet, you will do your work, you will not talk at all. And I had total silence for about 50 minutes for the class period every time. I was a very well-respected substitute teacher for that reason. And during that time, I was trying to decide what I wanted to do with my life. If I wasn't going to get another phone call from the NFL, I was playing arena football at the time, but that was in the later school year months. So I wasn't, during the fall, I didn't have anything to do but wait for the hopeful phone call that never came. And so I'm like, well, what's this option trading stuff? So during those quiet times in school, I would read every option trading book known to man, pretty much. And I'd often sometimes get in trouble for, this was before the days of the smartphone, and the internet was actually still relatively new at the time, so I'd get in trouble for trading on school computers sometimes. And things were going really well for me trading, and I was actually pulling in like $3 or $4 grand a month just trading options. And I'm thinking, man, if I don't get a call from the NFL, this ain't a bad way to make a living. And let me tell you, the whole world was totally stupid at that point in my life, except for me, let me tell you. But I had a $6,000 loss one day, and this is all with my own money, and that I'm on the hook for this $6 grand. And so I decided, okay, well, I need to kind of rethink things, and that I don't really have any, risk management. And so I came up with my 3 prongs of investing. I thought of, okay, I want to have a long-term style of investing, which I wrote about in my book in a lot of ways, Go Long, New Option Strategies for Buy and Hold Investors, and how you can use options for long-term investing. I had more of an income prong of investing, which I still use to this day, talk about on the show a lot. Then I have the 3rd prong, which is the speculation. Let's say you want to buy some calls right before the big announcement. What the heck? Have a hunch, bet a bunch. To this day, I really don't do much with the 3rd prong of it. I don't know if I've made a 3rd prong-esque trade in probably 5 years, quite frankly. I've just been sticking with the first 2. So with that, I knew that just trading options out of my crappy apartment really wasn't going to work for me at that stage of life because I didn't have some type of long-term approach. So I wanted to learn a little bit more, and I ended up getting a job with MetLife. And this is after I decided that I was done waiting for a phone call. With MetLife, I was a financial advisor, and I did really well with it. And I was my office rookie of the year. But primarily what I was doing was life insurance. And when I talked to some of these older, and I'm using air quotes right now, financial advisors, I talked to them, well, why would you do this annuity that your clients are getting charged $1 million %, and when you can just buy SPY or buy the spiders? They'd look at me and say, well, you don't make any money by telling them that. And so, after about a year of that, of just selling about $8 bajillion worth of term life insurance, I decided, well, this isn't really for me. I'm not at the right spot. Tried going on my own for a little bit and being independent. That really didn't work out. I just stopped that after a few months. And then I ended up applying for a job. I'm like, okay, this looks interesting to me. Options Express, brokerage firm, they were the hottest thing in town at the time. They had an opening for a field representative. What the field representative does is he goes around and he shows the Options Express website to the clients in various parts of the country, and he does these new things called webinars, explaining how the website works. It's like, okay, I could do that. I was an Options Express client. I always was this whole time, even in my career at MetLife. And I thought, okay, this might be something for me. So based on what they wanted in the interview, I'm like, well, this is a stretch because I don't have years of experience. I've never been a floor trader. I'm just looking at this, but well, what the heck, let's apply for it. So I actually got an interview on it. And what got me the interview is that I was talking with my eventual boss on the phone, and he just started asking me some questions. And he realized that I was very serious about option trading because I explained to him, he said something about a covered call and a short put, and I explained to him how they're the same thing, and he's just so shocked that someone who hadn't ever been in the option world before would know something like that, that he's like, I got to give you an interview. I got to just give you a shot because of this. And so I did really well in my interview. I told him, look, I don't have a lot of experience at this, but my experience comes from being one of your clients and being on the other side of this. And so with that, he says, all right, well, I'm really impressed with with how passionate you are about this and your knowledge base on this. I'm going to give you one more interview, and this is your big one. You can't screw this up. This is with the CEO of the company, Ned Bennett. And so anyway, had the interview with Ned, and so I am scared to death riding the train into this interview in Chicago. I'm reviewing every option term that's known to man because Ned knows everybody in the business. He'd been in there for 30 years, and I'm thinking, oh man, this guy's going to drill me. So I'll never forget it. I remember just going through, I'm like, crap, he's going to ask me what row is. What the heck is row again? I forgot what row was. I'll never forget that. So I called up a friend of mine on my cell phone. This is once again before the days of smartphones. What the heck does row mean? So he looked it up on the computer, so I remembered it. So I'm totally ready for this. I'm thinking he's going to just nail me with every possible question. So I get in there. He looks at my resume. He says, oh, you played in the NFL. I played college football. I played under Woody Hayes. So all it was about an hour and a half of him and me just telling football stories to one another, and that's how I got the job. Now, once I got that job, my boss at the time, Joe Cusick, had said to me, he's like, you can go a lot of ways with this job, Mike. You can really work your way to the top. This is an up-and-coming company, but if you're just going to chill out and hang on, I'm telling you right now, you're going to be fired within a week. You got to come up with what your value is to the company because you don't have a lot of experience, and I need to see that spirit in you that I saw in the interview, your passion. So, like, okay. So what I did was I traveled around the country, and I did Options Express did a lot of joint events with the exchanges, the CBOE, the ISE, the Philadelphia Exchange. And so what I did at all of these events, 100% of the time, these guys were like Marty Kearney, Jim Bittman, Steve Meisinger, and with that, I constantly asked them questions about option trading, and that's how I learned and got a lot better. So long story short, I got really lucky to get into a higher profile job, and that's how I got started with it. I was very passionate, and I worked my butt off. And that's how I got in. So with that long drawn-out story of how I got into the business, let's go ahead and end with a couple things here. Andrew, let's go around the block. What are you looking at in these markets for the next few days? And what do we got going on over at the option pit? There's got to be something that the people can benefit from that you guys have over there.
There is a couple things. One is what I'm looking at is kind of biotech. Also doing a little bargain shopping in the MLP world. Let's see if we can get a sub 10 VIX close because I'm still trying to figure out why it's here. It just feels like it should be lower. Also, our Option Pit YouTube page. We have probably more quality free content on our YouTube page than anybody else. As far as the webinars, that Mark's done a lot of great webinars on just option basics, option for using volatility, understanding how it works with spreads, all that kind of stuff. Free on so subscribe to our Option Pit page on YouTube. And also we're going to do our VIX webinar on Saturday, our Saturday classes. People really like them. And normally what we do is we walk through a scenario. So we have a low VIX market. How do you make money trading the VIX? And we go through the how, the why, and what the potential is for making dollars. And that's what our Saturday class. So hop on over to optionpit.com/events and sign yourself up.
For sure, for sure. And I'll even go one further with that. First off, if you are looking to trade, and since you're listening to this show, you probably are, and you hate that ticket charge. Well, at RCM, because of the fact that we have several $100 million of assets under management, we're able to negotiate a pretty nice commission rate with TD Ameritrade, with Interactive Brokers, with Trading and Money Block. And what we do, we have a program called RCM Access, to where you can trade under our umbrella. and enjoy a 35 cent a contract commission rate. At least that's what it is at TD Ameritrade through us. Now, keep in mind, there's a few restrictions on that, and we can talk about that if you want to give me a call. And we do charge a little bit of a fee for that because we want to make a little bit of money on it, but not a lot. But feel free to contact me at 312-212-3531 or shoot me an email at mtosaw@rcmfs.com. And right now we're running a little bit of a special. This is something that we believe that an educated trader a lot of times is a better trader. Not always, but a lot of times he is because he has a lot of things in his toolbox that can help him. If you do open up an account at RCM, assuming that you're not just trying to just open one day and then just leave the next day. I mean, we'll talk about that. There's ways with which we can protect ourselves from that. But if you open up an account with RCM, what we're doing right now, $100 credit towards anything the option pit has. That's right, $100. So if they have something that costs $1,000, it's only $900 to you. If they have something that costs $100, then it's free to you. If you open up a new RCM account, an account through RCM, and contact me on this. So if that's something with which you're interested in as well, feel free to contact me. But with that, on behalf of my co-host, I should say, Andrew Giovinazzi, we'd like to thank you guys for listening today. We'd like to wish everybody well, and let's have a successful trading day tomorrow on Friday. So long, everybody.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.